US Treasury yields and stocks fell overnight as weak manufacturing and construction data indicated monetary policy is reducing demand in the United States. The Aussie and the Kiwi dollars are up on the back of a weak US dollar, while oil is down more than 3%. India's Nifty 50 stock index rallied 3.5% overnight on market hopes for a third term for Prime Minister Narendra Modi. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ FX analyst Kausani Basak looks at why imports across Asia have started to improve since bottoming out last year.
The export value and volume has risen across the region, and this has spurred the demand for intermediate goods imports, which are required for the production of these exports.
But first, in 5 and 5 with ANZ, US Treasury yields and stocks fell overnight as weak manufacturing and construction data indicated monetary policy is doing its job by reducing demand and activity in the US economy. The May ISM Manufacturing Index fell 0.5% to 48.7. That was below expectations and the second consecutive reading in the contractionary sub-50 territory. Meanwhile, data also showed construction spending fell 0.1% in April compared to expectations of a small gain. At 4 a.m. Sydney-Melbourne time, the yields on US Treasuries were down between 7 and 12 basis points. Stocks were also weaker, the S&P 500 down 0.4%. ANZ Head of G3 Economics, Brian Martin, says both the manufacturing and construction sectors are very sensitive to interest rates and together account for 15% of US GDP.
I think it is sending a signal that demand is weakening, and we've just had the Atlanta Fed GDP Now estimate for Q2 updated in the aftermath of the data, and that has fallen from 2.7% before the numbers to 1.8%. And that's really bringing growth now back in line with potential. And I think, consistent with our view that policy is restrictive, is working to bring the economy back into greater balance, and is going to be successful in bringing about a renewed deceleration in inflation in coming months.
Number 2, the US dollar weakened with those lower Treasury yields against a range of currencies overnight. The dollar index fell 0.4%, and the buck fell 0.8% against the yen, 0.7% against the Swiss franc. It was only down 0.3% against the euro, ahead of the ECB's expected rate cut on Thursday. The Aussie and Kiwi dollars were beneficiaries of this US dollar weakness. By 4 a.m. Sydney-Melbourne time, the Aussie was up 0.3% at 66.65 US cents, while the Kiwi was up 0.5% at 61.70 US cents. ANZ Head of FX Research, Marja bin Zaman, says it's all about the US economy for the US dollar this week, ahead of non-farm payrolls on Friday night.
I think this week is a data-heavy week, a US-centric week, particularly weighing on US labor markets. We don't think this will be overly USD positive on balance. We did have early labor market indicators such as the Conference Board job differentials, which showed that no real change from April, with only slightly fewer consumers rating jobs as harder to get. So this does suggest more evidence of weakness in the US labor market, which is likely to present itself in the upcoming prints.
Number 3, the oil price was down almost 4% this morning. This followed the OPEC Plus group of producers announcing they'd restore some earlier production cuts later this year. Brian says there's also weakness on the demand side of the equation.
With oil prices down here, it is also suggesting that headline inflation should start to ease. Why is it down? Well, I think it is in part reflecting concerns about demand. Demand in the US slowing. The European economy, we know, is recovering, but it's hardly what you call gangbusters. And we know the Chinese economy continues to struggle. So if you take those 3 major blocks of economic activity globally, I think the oil price is reflecting quite a subdued growth outlook in coming quarters.
Number 4. In Australia, the Fair Work Commission announced a 3.75% increase in the minimum wage and award minimum wages from July 1. The rise was lower than last year, but exceeded inflation for the first time in 3 years, so real wage increases. ANZ senior economist Catherine Birch says the decision will directly affect about a quarter of Australian workers.
The FWC was quite considered in making sure that the decision will, A, provide a bit of a real wage boost for some of the lowest paid workers in Australia, but also not contribute to inflationary pressures overall. The RBA doesn't, publish explicit expectations for this, but we think that the outcome is likely within their expected range as well, and sort of aligns with the RBA's wage price index forecasts over the next year or so.
Number 5, the big number to watch in Australia this week is March quarter GDP tomorrow. But before then, we get the final pieces of the GDP jigsaw today with net exports, the current account, and company operating profits. ANZ senior rate strategist Jack Chambers says GDP doesn't normally move markets, but a soft result tomorrow could. ANZ is expecting a 0.3% rise for the quarter and 1.3% for the year. It'll finalise that forecast today after those last pieces of the jigsaw.
That 1.3% year-on-year rise would actually be the softest. If you exclude the pandemic period, it will be the softest since 2000.
And how closely will the RBA be watching this?
They'll give us a further guide to what the full GDP number will be. But I suspect that if markets are going to react at all, it will be to a softer result rather than a stronger one.
Jack Chambers there. Now, in our bonus deep dive interview, ANZ FX analyst Kausani Basak has taken a closer look at import figures for Asia, excluding China, and found a significant increase in volumes.
So monthly imports by Asia, excluding China, in absolute value terms have begun to improve after bottoming out in 2023. So imports by Indonesia, Malaysia, Singapore and Thailand has shown stronger growth, and imports by South Korea, Taiwan and Philippines, the pace of contraction has declined for these countries. And the imports have been mostly driven by higher volumes rather than higher prices.
And what type of imports are rising the most?
So the import volume is mostly being driven by the recovery in export sector in Asia ex-China. So the export value and volume has risen across the region, and this has spurred the demand for intermediate goods imports, which are required for the production of these exports.
And how much of a factor is the changes in supply chains in and out of China in this rise in intermediate imports into these countries?
The rise in imports are only being partly driven by the supply chain reshuffling. So in the effect of the supply chain reshuffling is stronger in some countries compared to others. So one of the example is Vietnam. Vietnam's import of intermediate goods from China has risen steadily. So the import component of Vietnam from China is right now at 38% as of April.
And how important are households as a factor in driving imports?
So households will not be a major driver of import demand this year. Household demand has been muted in the region for the past several quarters, partly due to the elevated interest rate. And we do not expect any interest rate cut before 2025. So this will likely keep the household demand muted. And at the same time, investment activity will also remain weak, considering that the business sentiment has now been subdued in these regions.
What are the risks that prices rebound and slow down the import volumes again?
So the oil prices rising due to elevated geopolitical uncertainty will be a key risk to the import prices this year. And risks also remain for food import prices, which can arise from lower supply due to weather-related factors. We can already see this in rice prices, which have started to rise, which can affect the rice importing economies.
Kausani Basak there talking to us from Bangalore. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, June the 4th. Catch you tomorrow with the final pieces of the Australian GDP puzzle, and we gear up for the ECB decision on Thursday night and US jobs on Friday night. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.